Inflation. The steady rise in the cost of goods and services is an economic reality that can erode the purchasing power of your money over time. As prices increase, the value of your savings diminishes. However, there are proactive measures you can take to tackle inflation and safeguard your hard-earned money. In this video, we'll explore 10 effective strategies to protect your finances in the face of inflation. Number 1. Review and adjust budget. Regularly review your budget to identify areas where you can cut costs or make more efficient spending decisions. By managing your expenses effectively, you can offset the impact of rising prices on your overall financial well-being. Number 2. Invest in valuable items. Sometimes we invest in things purely for the sake of it. The truth is that long-term, fixed-rate interest-bearing investments, geez, what a mouthful, are the worst kinds of investments to make during inflationary times. Any fixed-rate, interest-bearing debt securities fall into this category, although those with maturities of 10 years or more are particularly desirable. Instead of investing in these, you should invest in things that can't be duplicated easily, like land, real estate, or gold. You could also start collecting unique items like trading cards or antiques. Due to their unduplicatable nature, all these things are guaranteed to hold value during hard times, hence protecting and growing your money. Number 3. Review your investment allocation. When crazy times of inflation begin, it's a really smart idea to consult your financial advisor. You have to make sure that the investments you've made match your risk tolerance. Consider a reasonable asset allocation of 60% equities and 40% fixed income as an example. You should also consider allocating a chunk to dividend-paying stocks if you're income-focused. Bonds have historically struggled to keep up with inflation better than stocks. One of the most important aspects of money management is reviewing your financial portfolio. If you don't keep an eye on your investments, they could easily stray from your original plans. Therefore, you need to analyze your investment portfolio in a suitable manner. Finding every financial item you own and listing them in one location is the first step in any review process. Number 4. Understand what drives different assets, particularly cyclical stocks, such as those in the financial, materials, and industrial sectors. Commodities and foreign equities are worthwhile investments to consider. Some people are often fooled by historical correlations when they should instead comprehend the fundamental forces that drive the various assets. Although there may be a negative correlation between treasuries and stocks, as inflation rises, both of these asset classes decline. Number 5. Create a mix of investments. When you want to make adjustments to your portfolio, among the factors which you are required to take into consideration is inflation. For investors, diversification across a number of different asset classes is crucial in helping them navigate through a period of unpredictable stock market conditions. To keep up with escalating prices, I believe it's important to combine a variety of investments that are distinct from one another. By having a mix of investments, you'll be securing your money just in case one investment fails. You'll be sure that the other will work. After all, it's the market, and you never know where the scale will tip. Number 6. Maintain a rainy day fund. Most people make the mistake of investing heavily so that they can counter inflation. Although it's a good plan, you should first make sure that you have enough to cover you on rainy days. If you really want to live stress-free in tough periods of inflation, then you should definitely consider having at the very least $1,000 in your emergency fund. However, it's recommended to have 6 months' worth of expenditure saved. Opt for a high-yield savings account for your emergency fund as well as other short-term savings that you require quick access to. Compared to a bank account or conventional savings account that pays little to no interest, CDs help your money grow a bit faster. Although it doesn't pay enough to fully combat inflation, the typical savings account does help. You should start by paying off your debts first, before saving money in an emergency fund. Number 7. Explore the bond market. If you're debt-free and have enough money to take you through 3 to 6 months of living expenses, then you should start taking a look at what investment opportunities will keep up with the inflation rate. Some of these investment opportunities, like bonds, are 100% guaranteed to succeed. As long as inflation keeps growing rapidly, bond interest rates are always adjusted every 6 months. Regular interest is paid on bonds, and upon maturity, investors receive their principal back. So there isn't really much to lose with this. Number 8. Invest in your home. In the past few years, home prices have been rising exponentially. This is great news for homeowners, but not so great for the few who want to get into the market. Experts say that housing prices will stay high despite rising mortgage rates. Even with maintenance costs being so high, I'd advise that you invest in your house before you buy a new one. Inflation typically results in rising prices for everything, including rent, housing prices, and mortgage rates. Therefore, if you're thinking about buying a home and believe that inflation may be on the rise, you should wait. Investing in your own home has so many advantages. Like, due to the fact that their cost is constant regardless of the state of the market, homeowners are protected from rising rental prices. Number 9. Look at short and mid-term fixed accounts. Whenever you see signs of inflation, it's necessary for you to have a look at your retirement account and prepare for the impending recession. Considering short and mid-term fixed accounts, such as 2 to 5-year fixed annuities, is a wise move. A short to mid-term annuity can provide up to 3% fixed returns at current rates, whereas money market accounts and bank CDs offer little to no guaranteed rates. Number 10. Stay invested in equities that grow. Sometimes we do save a lot of money in our savings account, but inflation somehow finds a way to catch up with us. The thing is, you should now start investing in equities that grow like stocks. That way, you'll have your money growing regardless of inflation. The best course of action in situations like these is to maintain your investment position, preferring long-term assets like stocks. When inflation is between 2% and 4%, stocks perform the best. Tackling inflation requires a proactive and diversified approach to financial management. By incorporating a mix of inflation-adjusted assets, maintaining a diversified investment portfolio, and making strategic financial decisions, you can safeguard your money against the erosive effects of rising prices. Stay informed, be adaptable, and consider consulting with financial professionals to ensure your financial strategy remains resilient in the face of inflationary challenges. Well, thank you so much for watching. If you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more content like this. Until next time, take care.